Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is The Talking Point, and it is Tuesday morning, and it is February 21st. As I do this call, the market has opened, and it is down. Walmart and also Home Depot coming out with disappointing guidance, suggesting that the economic outlook is uncertain, but actually looking at it more towards the potential for the downside as the Fed continues to raise rates. I also want to point out something else. Both Home Depot and Walmart had upped their wages. And this is also putting pressure, obviously, on margins. So when you have to come in and your revenue comes down a bit, you have those higher wages. That's putting pressure on the margins and bottom line. And I want to mention why wages are so important, because this is the area that the Fed has been focused on, that wages have been climbing higher. It has companies trying to pass those higher wages as an input cost onto the final consumer. Consumer being a retail, that's us, or a business consumer. The problem is, and this is the concern looking ahead, is how long can that last? How long can the consumer staples names, for example, continue to raise their prices and have the consumer continue to buy their products? At what point does that begin to put even more pressure on the margin? So this is, an ongoing story, but it is important because when wages keep moving higher, the expectations are that the companies will be able to pass along those costs. But you can't do that if the consumers are not, coming in and buying as much as you had predicted. The question mark then becomes, do these companies have to then begin to cut costs? And that would include layoffs. So this is an ongoing story. But that actually is one of the concerns for those who are looking at the structure of the market, and it's trading at 18 times forward earnings, which is still rich, by the way, and whether or not, at some point there's got to be a give and give here. And is that going to be where companies say, again, we're going to cut costs, that includes layoffs, or are they going to come under even more pressure as they maintain their payroll and, have to live with paying out more, but with having fewer and fewer customers coming in and paying full price. So again, very important, I think, for the market. And this is something the Fed has focused on in addition to rents. And I'll get to that in a minute. But I just want to point out there's another element in the market and factor in the market that has the market concerned. And that is that last week we heard from two Federal Reserve members. Now, I want to point out that in 2023, they are not what we call voting members. In other words, the Federal Reserve meeting is the Federal Open Market Committee meeting. That's what it's called, the FOMC. And there is a revolving pattern with those who vote, and it has to do with the presidents of the regional banks, right? So there's the standing committee that always votes, and then the regional bank presidents rotate. So two of those who are well-known names, they tend to be on the hawkish side of the spectrum. One is Loretta Mester, and the other one is James Bullard. Well, last week, in public speaking forum, they were giving speeches. They mentioned, and I'll point to Loretta Mester, she said, we had talked about 50 basis points. We're seeing that the inflationary pressures, while they have come down and eased, but they're still there, and that perhaps we needed 50 basis points. And Bullard actually came out and echoed what she said. Now, this is important, and the reason it's important is the Fed has made it pretty clear that we would have 25 basis points this year. In other words, that at each meeting where the Fed believes it needs to raise rates, it would be 25 basis points, 0.25%. We have to see whether or not there is a consensus about, especially amongst the voting members, whether or not they believe at the next Fed meeting, which is in March 21 to 22, whether or not they need 50 basis points. As I said, it is a ongoing, how do I put this, ongoing discussion. Now, this week, we will have the minutes from the last Fed meeting. It'll come out in tomorrow. And we want to see, was there a discussion? Did it show up in the minutes regarding whether or not they should stay with the 25 basis points or should they move to 50 basis points? This is going to be important, as will ongoing Fed comments, particularly from those, obviously, who are voting members in 2023. Do they believe that we need to go to 50 basis points rather than stay with 25 basis points? I'll share this with you, and bear with me if it sounds complicated. For the March 21-22 meeting, Fed meeting, the probability of 25 basis points was reaching, 85, 80, almost 90%. It was almost a certainty. Well, I took a look at it this morning, and that probability for 25 basis points in March at the Fed meeting is now down to 79%, which means that left over, and that is for the 50 basis points. That is still minimal. It's not skyrocketing up there, but nonetheless, it has been climbing and inching higher. So what will help determine, whether or not the Fed goes to 50 basis points? Well, first of all, the Fed has been actually very good about telegraphing where they are, what they think they're going to do. Chairman Powell has mentioned it so many times that they were going from 75 to 50 basis points. You saw the dollar start to weaken as he started to mention that more and more. But the thing is, this week you'll have the personal consumption expenditures price index, right? That is the PCE. It is the PCE. It is the Federal Reserve's preferred measure of inflation. So we saw last week, we had the consumer price index, we had the producer price index, all edging higher, not screaming higher, but certainly hotter than you want to see. Let's see if the Fed's preferred measure, the PCE, comes out on Friday, whether or not that has inflation inching higher. Now remember, the PCE gets their information from companies, from businesses, whereas the consumer price index is completely consumer related. So they come from two different perspectives. Normally, the PCE runs cooler than the CPI, but you're seeing and hearing analysts who are saying, you know what, most likely that PCE may be just a bit hotter. If it's too hot, right? Remember, it's more than expectations. It may just be what is needed to get that probability of a 50 basis point rate hike higher, and then have the Fed, the voting members, start talking about it, telegraphing to the market that this is what the market should expect. So I want to point that out, that has become an issue in the market. Like, how long does the Fed have to go? That's one. And two, do they have to revert to 50? And not 75 by any means, at least at this point, but 50. And we're going to see it'll play out in terms of the data releases, and it will play out in what we hear from Federal Reserve speakers. They will guide the market. However, I also want to point out that the market is pricing in terms of probability, a third rate hike, whether it's 25 basis points right now, that's what it suggests, and that would come in June. So instead of just having two this year, which would have been February, and then in March, and then maybe the Fed pauses or is almost finished, the market is pricing in a third one for June. And whereas before, the probability, the futures market, which looks at probabilities, had two rate cuts at the end of the year. Now it is just one rate cut at the end of the year. The data will help determine what the probability is. Now, everyone says to me, Quincy, it's because you had worked on the trading floor. You look at this, futures market. It's all traders. You know what? That may be the case, but I can tell you this: the Fed looks at it too, because the Fed wants, this particular Fed, under Powell, wants the market to understand what it is doing and where it is headed, so that there aren't any surprises. So in other words, we shall be paying very close attention this week to the Fed minutes to see if there is anything in there that should suggest that more than just the two non-voting members now are looking at maybe we need 50 basis points. Are there others? Was there a discussion about that? Now, clearly, there may have been a discussion about it, but they came out with 25 basis points. So we know that was their thinking. But again, we're looking ahead, and so does the market. Also, I want to point out that the data that we have seen recently indicating the economy is stronger than most had expected. At this point, right now, as I do this call, the GDP is expected to be for this quarter about 2.5%. Again, that will be moves based on the data from this quarter. Now, I do want to emphasize that when we heard from Walmart this morning and also Home Depot coming in before the market opened, and as I alluded to when I started the call, they have said that they do not see spending picking up. In fact, they see darker clouds because of the Fed rate hikes, because they see the economy slowing. And in terms of Walmart, they're seeing more and more of their customers coming in and focused on necessities, meaning the food. And if you've been in Walmart, as I have, you'll see that when folks are checking out, the self-checkouts, it's primarily food. Those are low-margin items. And what the Walmart had hoped was that they would shop in the food area, right, and then go into the other aisles, particularly those who are shopping there, and more are, with household incomes above $100,000, that they would go for necessities and then go into the higher margin aisles. Nonetheless, what we're going to see, particularly because it's February, we'll probably see quite a bit of sales, getting rid of inventory. Home Depot sees slower earnings as well as again, the consumer is more careful. Also, I want to mention in this call, in terms of this week, the housing data that we had last week actually is better than expectations. And so we're going to listen to what Toll Brothers has to say. Now, remember, they have a higher income customer across the country. But what we do know is, from previous comments that Toll Brothers has made, is that they are actually offering more in terms of, the upgrades, what you want. In fact, giving away some of the upgrades or charging less. But what we want to hear is, are they seeing more foot traffic? Are they seeing Americans, moving and therefore selling houses or perhaps getting a second house? What are they seeing in terms of the U.S. consumer? And I do want to stress that they do focus on a stronger U.S. consumer. With that said, I mentioned this in another call, we are seeing more delinquencies in auto loans. Yes, and the reason is that auto loans were so easy to get, especially during the pandemic. Some of them were, I think, actually subprime. I don't know the percentage of all of the loans that were subprime, but subprime auto loans picked up handsomely as consumers wanted to get new cars during the pandemic, actually, when loans were easy to get because there was so much liquidity in the markets. In addition, they had more money coming into their bank accounts and savings accounts, so they were able to do that. But now, as the pressure is picking up, they're seeing more and more delinquencies. One of the issues with auto loans and delinquencies, by the way, is that you can repossess a vehicle. So while there is concern that this may spread to other loans that folks have, including mortgages and late payments, and then perhaps delinquencies, but they're up, they're ticking up in the mortgage area and with loans, but nothing that is a red light. It's just that it's ticking up a bit, but not a red light, just with auto loans. But you can repossess the vehicles and then sell them. So remember that, because when we went through the subprime collapse, many of the analysts would always say, look, we're seeing the auto loans just basically people just are not paying, but they were able to repossess them and then sell them again. But it is something to keep our eye on if, and I'm going to stress this, if rates continue to climb higher. Now, with that said, I'm looking at the 10-year Treasury yield this morning. It is inching over 3.9 and it touched 3.9. Let's pay attention to whether or not it can actually cross over 4%. I mention this because of the following. There's an understanding that rates can climb higher and the market could live with it as long as the underlying economy is strong, right? It's not a negative. However, and this is the key, once you climb 4%, the market will get jittery. That is going to hurt, at least psychologically, the mindset in the country. And you marry that with what we just heard from Home Depot this morning and what we heard from Walmart. And if it climbs above 4% and stays above 4%, it could be more significant for the market. It certainly will be significant for the technology names. And, although we always look at the NASDAQ, the S&P 500 has a good portion. Actually, it's the leading sector within technology, within the S&P 500. Remember, technology is a long duration sector, meaning they get their profits in the future. And so when rates continue to climb higher, it tends to be a negative for the technology names. So we're going to pay attention to that too. So there's an awful lot at play in this short week. The short week is certainly a long week for traders and investors. And in addition, February, the second half, tends to be a difficult month for the market statistically. And we have to keep that in mind. Certainly the traders who are in and out of this market every single day, all day long, understand that the second half and the end of February tends to be difficult, meaning that statistically the market tends to pull back at the end of February. So all of this together tells us that we want to be a bit careful in the market this month and pay attention to what the Fed speakers have to say and also what the inflation report on Friday indicates for inflation. And I'm going to repeat this. The PCE, Personal Consumption Expenditures Index, the PCE, is the Fed's preferred measure of inflation, and it tends to run cooler than the Consumer Price Index, the CPI. So therefore, if it runs hot and even hotter than the Consumer Price Index, the market is going to take notice, and it may be a difficult how shall I say, data release for the market on Friday. And we're also going to pay attention to the Fed speakers. I don't know if Loretta Mester is on tap to speak on Friday. I have read reports that she is. Remember, she's a non-voting member of the Fed, but she is the one who said just recently, I really thought that we should perhaps have 50 basis points for the February meeting. We'll see what she has to say. Even though she's not a voting member for 2023, she is highly respected. Her opinions are highly respected by the market, both by doves and also the hawks, on the board. So much for the market to absorb this week. Please don't hesitate to get in touch with me. Take good care, and we will be back on Monday. I always have trouble when it's a Tuesday. My first instinct is to say, well, welcome, it's Monday morning, but today is Tuesday. But I can tell you that in terms of data releases, the Fed minutes that we are going to pay attention to, and also the PCE Fed speak, and we're going to have consumer spending, but remember, that looks back. What we're looking at is looking ahead. And what we heard today from Home Depot and from Walmart was their guidance. And guidance is exactly that. It's looking ahead. What do they see from their customers? So take good care, and please don't hesitate to get in touch. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.